Well, Wall Street bulls are charging into the new year. Signs of a soft landing for the U.S. economy have pushed the S&P 500 index up nearly 23% this year, with more strategists optimistic over the Federal Reserve's dovish forecast on interest rates next year. But is it too early to be this bullish? Our next guest doesn't think so. He sees the S&P hitting a new high at 5,500 by year-end 2024. Joining us to break down the market outlook in the year ahead, we've got here on set with us Jay Hatfield, Infrastructure Capital Advisor, CEO, and Yahoo Finance reporter Madison Mills, also joining as part of Yahoo Finance's 2024 Investor Guide. Jay, great to have you here on set with us. First and foremost, what is the biggest risk to your outlook here?
Thanks, Brad and Shauna, for having me on in studio. Well, if you really track back to what our non-consensus call was, we had a 4,500 target, which is actually more bold than our 5,500 relative to what all the other strategists are at, and really focuses on Europe. Most U.S. investors, rightly so for equities, don't focus on Europe, but we're fixed income investors primarily. And Europe is in a recession. They have a GDP now, which you can access on the web. They're tracking negative 1.6%. This quarter, they were negative 0.4 really, if you annualize it last quarter. And so we think the ECB is going to be forced to cut first, which will give the U.S. Federal Reserve cover. And in fact, if you look at the futures market globally, every OECD country is projected by the futures market, not us, to cut rates by an average of over 150 basis points. So it's really more of a global focus, because I am nervous. You saw some Fed officials about the Fed. They are still in their Phillips curve mentality that we have to have a recession to eliminate inflation. But that's really the heart. So I would urge your viewers to focus on Europe and see when the ECB cuts, because they're probably going to be first.
Yeah, Jay, I wanted to bring up the whole aspect of rate cuts and how much of your call really hinges on that, because like you just alluded to, we heard from Austin Goolsbee, who was out making comments over the weekend, just saying that it is still too early to really call a victory here in the fight to tame inflation just a little bit. What are you forecasting in terms of that more aggressive outlook that you have for next year? I know a lot of it depends on what we see internationally, but how much of that, I guess, is factored in terms of Fed rate cuts and what exactly that looks like?
Well, that's a spectacular question, because you should never quote multiples without talking about interest rates. So we have a discounted cash flow multiple. And so roughly every 25 basis points is a full S&P multiple. So we're forecasting 3.5% on the US 10-year. So what's great about our simple model is you could say, oh, well, I don't believe that. I think it's going to be 4. Well, then you take 2 multiple points out, which is roughly 500 points. So you could get down below, actually, those targets you just put up there. So it is really based on an optimistic view on interest rates. But that has been unfolding. And like I said, now it's actually consensus we're going to have cuts. It's not 2 months ago, we were saying Europe was going into recession, and there were no expectations. Now it's really globally. So if that unfolds, then our case is likely. And I would say the risk is to the upside on our case because of a potential AI overvaluation. So you could get 21, 22, 23 times, assuming rates are, or in fact, rates could go to 3 even if we do have global rate cuts.
Can you talk about that a little bit more, AI overvaluations? How is that playing into the outlook that investors should have this year?
Well, you know what's something strange that I learned from being an investment banker is it's actually efficient to have massive overvaluation. And the reason for that is when you have new technologies, the time to market is more important than efficiency to market. So if you create a Google in 2001, even though you had a web van, you're ahead of the rest of the world. So that's why the US always beats other countries to the market, because we have a more efficient capital market. And strangely, to be efficient, you need overvaluation with regard to brand new technologies.
You know, as we think about so many different areas that investors are going to have to consider and think about next year, there's so much of the demand environment, especially within housing, that's also going to be catching attention, because there's all of the trickle through from what people are paying in shelter and how much that has been the stickiest form of inflation as well. What's your outlook there?
Well, that's another great focus, because really, if you want to predict the economy, both inflation and GDP, housing is the most important. It's the most cyclical. It always cracks in a recession. Average recession, you have 870,000 starts. We now have 1.4 million. So that's the key to stay out of recession, because some bears are predicting recession, which doesn't seem to be the case because we have a shortage, but it's also a key driver of inflation. Actually, housing prices are rising, but thankfully rents are cooling. We have 440,000 new apartments coming online this year. So that's why we don't think inflation is going to accelerate and the housing market will be okay. But if we are wrong, it would be centered around housing, a crash, or inflation rocketing higher.
I don't want to let you go without talking about the China elephant in the room. You say that we're mispricing the growth story to come from China. Where am I missing that in my understanding?
Well, of course, being negative makes everybody popular on press, so we're typically not very popular.
Don't be popular.
Yeah.
Just say what's right. Yeah.
But if you really look at China, there's a dynamic that people don't appreciate. They save 45% of their GDP every year. We save about 20. So they have built-in growth, because if they invest just adequately, they will grow.
Right.
And if you really look at the projections, they're really going to grow about 5 or 5.5, which kind of makes sense. That's sort of not that great return on 45%. But everybody focuses on the housing market because that blew up in the US and it makes great headlines. And it is terrible, but it's an advantage of a communist country is they can go bail it out at a moment's notice. They don't have to pass it through Congress. And also, they already have loose monetary policy. They're already expanding their monetary base and lowering rates because those are linked. So that's why we're not super bullish on China, but we're bullish that they'll continue to consume oil and prop up our market. And we think today's weakness is really just seasonal. It's raining, but it's super warm in New York, and that's why oil prices are depressed.